Hello, thank you so much for the introduction. I just want to make sure you can actually hear me because it looks like my video isn't working. Don't know if you can see me.
Yes, Stephanie, we can see you and hear you.
Oh, wonderful. Okay, so I can't see that. So I'm going to go ahead and just share my screen then. Let's see. Awesome. Okay. So welcome, everybody, and congratulations on being here and making the decision to become more financially literate, because no matter what your reason is for being here, just acknowledge it, and whatever your motivation, I support you, because the best way to build your wealth is to improve your knowledge. Okay, so my goal really is to make this as much fun as possible as you learn along the way. So I don't want to give you like a boring lecture or anything. What I really want for you to achieve is to understand what makes a great investment portfolio, learn the concept of index investing and how it relates to ETFs, and the best way to select an ETF, okay? So I've created a quick poll, and you can take a look here on the side. You should be able to see it, and pick the first thing that comes to mind. What does an ETF stand for, okay? So while we're waiting for those results to come in, I'll just take a moment and introduce myself. So my name is Stephanie Wolfe, and I'm an accredited financial counselor of Canada. Now, my background is unique in that I spent 15 years of my career launching and marketing products that were sold to investors and traded on the stock exchange. But today, my mission is to help women just like you build their confidence with money and create financial independence to live the life of their dreams. So I show my clients how to set up effective cash flow systems, set investment goals, and ultimately learn how to invest. So come and connect with me on social media and join the party. Okay, so I wanted to see what the results of the poll were, but when I was going in there, I actually couldn't share the results. So I don't know if whoever is, if there's any tech help that can tell us what some of the most popular answers were. I don't know if you can pop in there and see, but we can always come back and publish it later. So I do encourage you to take a look at that. So ETF actually stands for Exchange Traded Fund, okay? And at the end of this presentation, I hope that you're gonna know what it does and how you can actually buy it, okay? But first, we're gonna take a step back, and we're gonna talk about something that is very important to every investor, which is what makes a good investment portfolio. Okay, so we're going to start with a quick crash course on investing for those who are new to the concept. I realize there's people of different, investment knowledge here, but we're going to start at the very beginning. So we'll start with the stock market. What is it, right? The stock market is really a place for buyers and sellers to meet and negotiate trades, and the exchange tracks all of it. So in Canada, we have a couple of exchanges. We have a few. The two most popular are the S&P TSX and the NEO exchange. So the stock market is composed of stocks from hundreds of different companies. And each share of a stock represents a small portion of ownership of a specific company. So every company has a different total of number of shares available to purchase. So when buyers and sellers meet on the exchange, and there are more buyers than sellers in the market, the stock price will rise. And on the flip side, when there are more sellers than buyers in the market, the stock price will fall. Supply and demand. So when you purchase even just one share of a company, you become a partial owner of that company. So I've used Facebook as an example here. So the ticker for Facebook, that's the symbol used to identify the company on the stock exchange, is FB. So you can think of a company as a pizza, and the more slices or shares that you own of that company, the larger your slice of the pie is. So even if you own just one Facebook share, you are a partial owner of Facebook, which is very cool, right? Okay, so now that you know what the stock market is, let's chat really quickly about the S&P 500 index. So this is by far the most popular index and the one that you hear probably all the time about. Why? Okay, well, it measures the stock performance of 500 of the largest companies in the United States. So very simply, you can think of the S&P 500 index as like all the 500 most valuable public companies in the United States combined into one index. And these companies are from all different industries of the economy. And of course, the US economy is the largest in the world, which is why this is often used as a good metric, okay? And why people refer to it all the time. So sometimes when investors hear, new investors hear words like the S&P 500 or stocks or buy low, sell high, it sounds really risky and fast. And, there's this fear that investing is kind of like gambling, but that's like the sexy side of investing. And that's the one that the media likes to talk about all the time. But, long-term investing, that's kind of the boring side. And that's what I'm talking about here. So when it comes to investing, the risk that you expose yourself to is dependent upon the investment strategy that you establish. So at the end of the day, the first key to investing successfully is to minimize your risk and maximize your return as much as possible. So emotional risk is a big factor in investing, and it is really fueled by the media. And this is why there's this perception that investing can seem really intimidating. At the end of the day, though, I'd say that there are two types of investors, okay? There's day traders and there's long-term investors, okay? Now, day traders get a lot of attention, especially from new investors, because it seems like a really great way to make money fast. But there was actually, in Forbes magazine, the estimated success rate, they did the study for day traders, was only 10%. But some other experts put that lower, that number even lower. So like 90% of day traders are losing money on an annual basis. So on the other side of the coin, we have long-term investors. Now, average long-term investment performance has proven to give you far greater return when compared to short-term investing and quick trading. And this is because long-term investors never worry about trying to time the market declines and recoveries, because the market's going up and down all the time. And they really ride through inevitable ups and downs that are going to happen. So a really good example, one of my favorite studies, was Fidelity had conducted an internal performance review of their accounts to determine what type of investors received the greatest, most profitable returns between 2003 and 2013. So remember, this includes 2008 financial crisis, okay? And the customer account audit revealed that the best performing investors were either inactive or dead. Okay, so you heard me right. So it was the inactive investors. They were defined as the people who often switched jobs and they forgot about their 401k or your RSP in Canada. And so in other words, they were the ones who invested and then really did nothing with it over the long term. Okay, so I just think that's an interesting stat to share. Okay, so in addition to eliminating emotional risk and that day trading of jumping in and out, you want to ensure that you have diversification, because even the most successful companies are not exempt from risk. So if you think back like 20 years ago to companies like Blockbuster and Kodak, and they were, leaders in their time, but not anymore. So you could invest in what seemed to be a stable and really well-established company today, and then fall victim to, it falling apart, or even, scandals like Enron that happened in 2001. That could happen. So this is why successful investors are always going to incorporate diversification into their investment strategy, because it will minimize the overall risk associated with your investment. So you can do this a couple of ways. You can invest in multiple stocks of different, different values or different industries, and really, simply put, like the more diversified you are, the less risk you take on. Okay, so let's just jump into index investing and take a moment to look at what's available for someone who really doesn't want to comb through all the research and analysis that you need to do when it comes to picking and selecting individual stocks, okay? So I'm going to introduce you to a strategy called index investing, okay? So index investing really follows a passive investment strategy that seeks to replicate or mirror the returns of a popular index, such as the S&P 500 index. So we already understand that long-term investing is more effective than short-term investing, and that a diversified portfolio has a lot less risk. So therefore, our investment strategy should include investing into separate index funds, allowing for diversification of our portfolio. So there are a few advantages to index investing. For starters, research has proven that index investing tends to outperform active managers. Those are those investors who pick individual stocks over a long-term time frame. So taking a hands-off approach to investing really eliminates some of the biases and uncertainties that arise with individual stock picking strategies. and the desire to time or buy and sell, you know, when emotions are high, right? And you have like fear of missing out. We've seen a lot of FOMO over the last year with the market on a tear. So the beauty of index investing is that you can become an index investor by simply investing in exchange traded funds, so ETFs. So here it is. This is like the moment you've all been waiting for. So an ETF is a type of investment stock that is bought and sold throughout the day on the exchange, just like the individual company stocks, okay? So the only difference is that an ETF takes a bunch of companies and rolls it into one individual stock, okay? So in that sense, ETFs are already diversified for you because they have a combination of stocks already in them. So it's, you know, there is an ETF, honestly, for almost every index and industry out there. Now, I've actually used some very, you know, high-level local Canadian examples of individual tickers that replicate the S&P 500 index here. And you can see them there on the side. Okay, but one thing I just want to point out here, and I wanted to highlight this because I hear it a lot. So ETFs are not mutual funds, okay? This is very briefly, but ETF and mutual funds, both of them are a type of index fund, okay? So there are mutual funds that are index funds, so I don't want to confuse you there. But there are a few differences. So one of the main differences between ETFs and mutual funds is that an ETF can be traded throughout the day, similar to stocks, whereas mutual funds can only be bought and sold at the price that it's set at the end of the trading day. Also, mutual funds typically have like a higher minimum investment amount to get started. So sometimes, you know, from $500 to like $5,000. And for my Canadian friends, especially, mutual fund fees are pretty high, okay? They've been coming down over the years, but they are still some of the highest in the world. So I would just caution you to review fees when you invest, and I'll get to more on that in a minute, okay? Now, I want to dig into the good stuff now. So you understand how the stock market works. You know that you should be minimizing your investment risk, and you can do it through long-term investing and diversification. And you know that you can get all of this in an ETF. So how do you go about buying an ETF? What do you do? Okay, so first, there's a few ground rules that I would just like to call out here, okay? Okay, first one is that I can't stress this one enough. You need to know what you're investing for and why, all the time, okay? That is like the #1 rule. If you don't understand what you're investing in, then don't buy it, okay? That's just bad news. And know that all ETFs are different, okay? And it's really important that you understand your personal risk profile and the amount of risk that you want to take on to help you reach your investing goals, okay? So those are just the ground rules I like to lay out there, okay? So the very first thing I'm going to highlight 3 things that you need to look at when buying an ETF, but I will say that there are several more indicators that you can look at when selecting an ETF. These are probably the 3 most popular, okay? So the first thing you want to look for is the MER, or the ER, which stands for Management Expense Ratio. So you can find really detailed information of an ETF from the actual investment manufacturer, that the company websites. So for this example, and throughout the rest of this presentation, I'm using Vanguard's S&P 500 Index ETF, which is VFV, just as an example. I have no preferences or biases to any particular products. I'm just using this one as an example. So you can look, you know, there's other platforms you can also use to compare and do research. There's Fund Data or Yahoo Finance, things like that. Okay, so we're just going to go through here and use Vanguard. All right, so when you're looking for the MER, I've circled it there in purple. You can see it's 0.09%, okay? And the management expense ratio, this is really the fee that you pay to buy and own that fund, okay? So this is a really important metric to look at when you're comparing products, like I said, especially if you're a Canadian, because they are much less expensive to own than mutual funds. And, you know, the love for mutual funds, you know, they're really high around the world. People really love them. But the average MER in Canada for that sits still around 2.23%. So while that may not seem like, you know, a big percentage, I'm just going to show you something real fast here to break down the difference of these fees, okay? Okay, so what I've done, this chart just illustrates a $10,000 initial investment split 4 ways, okay? So I've used an 8% return over a period of 30 years, illustrative purposes only, plugged in the numbers. So you'll see the MER there of a $10,000. The amount of fees that you would pay over 30 years amounts to almost $2,500 in fees. So you ultimately get to keep with your, at the end of the day, just over $98,000. So you take a look down this chart and you can see what that 2.23% fees paid column looks like. Okay, you're looking at $46,000 in fees, which is a very big difference. So I can be difficult sometimes to compare percentages to dollars and what that really looks like. And like I said, may seem like a small amount, but these are the real numbers. Okay, so just wanted to call that out and why fees are important when you're looking at your investment portfolio, because unlike you, I want more in my pocket at the end of the day, right? Okay, so the next thing that you want to look for when buying an ETF, really you just want to see, is this ETF really holding what it says that it's going to hold, okay? You want to take a look under the hood, okay? So you can find that tab. For Vanguard's example, it's underneath portfolio data. Most of them will have similar layouts on their websites, all manufacturers. And so when you dig down, you can see the second mini screenshot I have here is the holding details. And they have all the names of the companies there. They break out the market allocation. So what country is it from? Obviously, this is the S&P 500 index, so it should all say it's in the US. And you can even see, you know, what percentage. You can dig deeper into the holding details to see how it's actually broken out within the ETF itself. And so this is really important too, because if you own several ETFs, you want to make sure that you're not crossing over in terms of companies that you're holding. There is such a thing as too much diversification. So this is a really important thing to dig into, and this goes back to know what you're investing in and why, okay? Now the third thing that you want to look for is liquidity. I'm not going to get into all of the details around liquidity right now, but in this sense, I'm using it in the term of really how easy it is to buy and sell and make this trade. So what you're going to be looking for is trading volume, and volume is really just the amount of shares that trade on any given day for a particular ETF. So essentially, the higher the trading volume, the better. Why? Because this is going to be reflected in the spread. So I've highlighted here something called the bid and the ask. Now, you'll recall at the beginning of the presentation, I explained that on the stock exchange, there's buyers and sellers. So you're going to have a price at which someone is willing to buy the stock, which is the bid price, and the price at which someone is going to sell, which is the ask price. So the difference between these two prices is called the spread. And you want to make sure that that spread is as thin as possible. So here it's like, you know, 1 penny, which is fantastic, which means this is a lot of volume, a lot of trading happening. This is a very active ETF, okay? And it really just is, this is demonstrating how liquid the assets are in the fund, okay? So I'm just checking the time here. Okay, I'm right on time. All right, so final thoughts, best practices. So before investing, like I said, it's really important to understand your risk profile and goals, and that you have an emergency fund established. I know that a couple of the other speakers have mentioned this. It's just important that you have your own stash of cash, because you don't want to start investing and then have to pull assets out of your investment funds to make ends meet, okay? So make sure you've got that in place. And personal finance is personal, so it's important that you understand what you're doing and know that risk is involved, okay? So there are some questions that I did ask on my Instagram. I wanted to know what people were looking for when I was doing this presentation. So if you've got several ETFs that all have the same benchmark, similar performance, or same performance really at the end of the day, you just pick the least expensive one, okay? There is a lot of that out there. You can hold as many ETFs as you want, but like I said, over diversification is a thing. So you can actually build out a pretty solid diversified portfolio with like 3 to 5 ETFs. I've just thrown that there. I did see there was a question. Somebody wanted to know what are examples of good core ETFs. You know, there's a wide variety out there. If you want to look at some of the indexes here that I've listed, like you could look at XAW is the MSCI World Total in Canada, and XIC, which is the Canada Broad Market Exposure, and you saw VFV, which is US. So those are some of those core indexes that you can take a look at and really start there and basically build out your diversified portfolio. So I will go in and answer any other questions that you may have around this, and hopefully I can share those poll results shortly. And like I said, don't forget to connect with me on Instagram. It's at Wolfe Collective Wealth. I would love to see you there. So that's it for me.